Hi, this is Peter Nelson with Nelson Insurance Advisors. I am here interviewing Logan Hertz. And what we're going to focus on today is talking about foundational, how insurance is a base for, for our financial, all of our strategies that we're actually doing. It's a foundational product. Okay. So of course it even talks about it, in the Bible, building, not building a house on sand, but building it on stone. So Logan is just going to go into real quickly about how you can um, build your foundation on stone. Go ahead, Logan.
Yeah, I like sports analogies. Okay. Offense wins games, defense wins championships. Okay. When you see some guy hit a half court shot at the buzzer that wins the game, you'll see that clip going on over and over and over and over and over again on Sports Center. Okay. But you know how much time professional basketball teams spend practicing half court shots? Zero, right? You won't see played over and over again on Sports Center all the defense that they played, right? Because there's not too many highlight reels, but that's how you win games, right? Hitting a half court shot is very rare. Same thing is true in the financial world, okay? And continuing the sports analogy, when you play defense effectively, you have to play defense as a team. On offense, there can be individual contributions that mean more, but on defense, you have to play defense as a team. So if you're setting up your financial castle, you want to make sure all the walls are protected. You don't want to leave one unprotected. Okay. So it's better to have more modest protection across the board than have super robust protection in one area and leave another area uncovered. And yeah, so oftentimes people, when it comes to finances, they rush immediately to playing offense and they don't set up their defense first. And the thing about it is playing defense is much easier than playing offense when it comes to finances, right? When it comes to insurance, just pay a premium. Pretty straightforward, right? Just pay a premium. And you've now set up a very good, robust defense. A lot of people think
Logan,
that
let
rich
me
people,
stop you real quick. Sorry about that, but I just thought of something. So what you're saying is, in a way, is that if you build the foundation and you build that defense, right? Doesn't that mean, because you've built a solid defense, doesn't that also mean that you can actually be more aggressive on your when you go to offense? Because you
100%.
so I just wanted to
Absolutely.
that hit me right
Absolutely.
away.
No, it's absolutely true. Now you have the financial security to play offense safely, knowing that if some of your investments don't work out, it's not going to ruin you, right? And savvy investors, when they take on risk, they always take steps to mitigate that risk. They always set up their defense first. They don't just throw money into the market. Okay. So, as an example, a more advanced strategy is people who invest in the stock market will be buying put options. Okay. If you're putting your money in the stock markets and you're not researching the companies you're buying, and you're not using at least some basic option strategy to protect your position, then in my opinion, you have no business being in the market. Just do something else. Okay. Invest in what you know. Don't invest in something you don't know. Right. But yes, when you play defense properly, then you can play offense. Again, getting back to the sports analogy, if you score, it does you no good to score points if you then just let the other team score. Right. So, as an example, people can start making good money and then all of a sudden they have some catastrophic event happen to their health, and now all that money that they made is effectively gone because they end up spending it on this catastrophic health event. Okay. The number one reason people file bankruptcy is for medical reasons. Okay. It's not because they made a bad investment, something unexpected happened. So I think a picture is worth 1,000 words. Let me show you a little framework that I have built that I think expresses it quite nicely, playing along with, again, offense wins games, defense wins championships. Okay. So you want to have your priorities correct. We don't want to jump in and start putting money in the market and putting it at risk before we first set up our defense. So protection, then savings, then investing, and then speculating. And in other places, I make the very important distinction between those three: saving, investing, and speculating. The reason why most people are nervous about retirement is because most of their so-called savings is actually in speculative vehicles where it's at risk. Okay. And they're hoping for some kind of return, but they don't have any guarantees. Okay. That's speculating. Now, again, I make that distinction more clearly in another video on my website. But here we're going to focus on protection. Okay.
Yeah.
Insurance is a foundational asset. It is a financial asset. It's not a cost to be minimized. That's the way most people view it. That's not the way rich people view it. Okay. Rich people probably need insurance less than the average person because they're rich. They can handle it, right? But guess what? They have more insurance than anybody else because it's the most efficient way to mitigate that risk. Okay.
Yeah,
Most
and I
people
have an
think that
analogy,
people,
Logan. Let me just mention, I have an analogy for that. I heard years ago that, people say, well, I don't need any insurance. I have plenty of money. Well, would you walk into a Mercedes dealership and pay 40% higher if you didn't have to? And they always say, well, of course not. That would be dumb. And that's exactly the premise of insurance, right?
yeah, pulling risk among a lot of different people, right? Well, everybody thinks, Peter, that people play a bunch of offense, they make wild, risky investments, and they get rich, and then they start playing defense. Then, now that they have the money, now they focus on protecting it, and they switch. It's like, no, 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 no. The rich person's mindset was the same before they were rich as it was after they were rich. The reason why they're rich is because they always focused on asset protection first. That's why they're rich. They didn't all of a sudden change their mindset. Nothing magically changed after they got rich. The habits they developed before they became wealthy were the same habits that made them wealthy and that kept them wealthy, right? So rich people are always focused on asset protection first, and they view insurance as a financial asset, not as a cost to be minimized, which unfortunately is the way most people view it, which is why most people are one catastrophic event away from bankruptcy. I know a guy who he made good money, didn't have a financial problem, or so he thought, got diagnosed with cancer, and he ended up declaring bankruptcy. That happened to him twice. Then later, his cancer came back. He ended up having to declare bankruptcy again. Okay. What if he had spent a small amount of money on a critical illness insurance policy? Keep in mind, these people had health insurance, by the way. Okay. These people who declared bankruptcy, they had health insurance, oftentimes good health insurance through an employer. Okay. But there's so many other costs associated with having a major health event that people don't think about. And there's a huge psychological component as well. You're not going to be in a position to necessarily make great financial decisions when you get that kind of a catastrophic health event. Okay. So, but I want to talk about a few things here that people don't necessarily think about as assets, right? So, any asset you have, you want to protect it. Okay. And I've come up with what I call the 1% rule. Okay. Which is basically any asset you have, you should be willing to pay roughly 1% of the value of that asset per year in order to insure it. Okay. That's just a rule of thumb. Okay. Okay. So, what is your most valuable asset? Well, if you ask people that question, there's no necessarily one right answer to this. Okay. But a lot of people will say my house or something like that. They'll think of the thing that if I sell it would give me the most money. Right.
I know.
But really, really, when you think about it, your most valuable asset is your ability to generate income, right? You can weather a lot of financial storms if you still have a pretty steady, reliable income coming in, right? Okay. So if you make $150,000 a year, wouldn't it be worth spending, let's say, $1,500 a year to insure that income? Okay. This is what we call disability income insurance, as an example. Okay. What we're doing is we're protecting our ability to generate income. So if something happens to us health wise and we're unable to work, that income is not interrupted. It continues. Okay. What about your health, right? That's a valuable asset. And here, I'm not necessarily talking about health insurance. Most people know they need that. And by the way, health insurance isn't really insurance. It gives insurance products a bad name. Okay, we can go into that. But I'm talking about something more that operates like real insurance, like a critical illness insurance plan. Okay, which what it does is it pays you a lump sum benefit if you have some kind of a critical illness, heart attack, stroke, cancer, something like that. Right. So you can sign up for a critical illness policy with a $500,000 benefit. Right. So as soon as you have that diagnosis, you get $500,000. No wrangling with the insurance company as to was this a justifiable expense, blah, 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 because it's not reimbursement based. It's indemnity based. It's very straightforward, black and white. Yes, you have a cancer diagnosis. Here's your $500,000. Okay. As an example, right? So that guy who had to declare bankruptcy because he got cancer twice, if he had had the foresight to put a critical illness insurance policy in place, which is not expensive, okay, he then would have been protected. He would have gotten a nice lump sum benefit that would have helped him to cover all of his medical expenses that he had to pay out of pocket and all those other expenses that you have out of pocket related to a catastrophic event like that. Okay. Now, here we come to my favorite topic. Notice another asset I put here on the left, your income, your health. How about your insurability? This is one that a lot of people don't think about, okay? If you are still healthy or reasonably healthy, you are still insurable. You can still get insurance, but that is not always necessarily going to be the case. You may not always be healthy enough to get insurance, okay? So you want to protect your insurability. Lock in your rate now. So a lot of people during COVID, when interest rates were extremely low, they locked in a low interest rate on their mortgage, which was a smart thing to do. Well, apply the same thing to insurance. You're not getting any younger. Why don't you lock in your rate now? Okay. So as an example, to protect your insurability, you have to own your insurance policies. If you rent an insurance policy from, say, an employer, so if you have disability coverage provided by your employer, okay, that's great, good, I'm glad you have that, but it's not protecting your insurability. So getting back to our offense wins games, defense wins championships, what's happening is you're leaving a base uncovered. You're leaving one of your walls unprotected. Yes, that disability coverage you're getting through your employer does partially cover your income, but it does not protect your insurability. When you leave that employer, or when that employer decides to stop offering you that benefit because they're under no obligation to continue it, what do you do now? What if you're not insurable anymore, right? What if your health has declined? Or maybe you have to pay a more expensive rate just because you're older, right? You want to lock that in now. So you want to get an individually owned, non-cancelable disability income policy, which means you own the policy. And not only can the insurance company not cancel the policy, no matter what happens to your health, they cannot even raise the rate. So if you lock in that rate when you're 30, you'll be paying that same rate when you're 60, right? Think about what a little bit of foresight did for you there, right? An ounce of prevention is worth a pound of cure, okay? Now, no matter what happens to your health, your income is protected and the cost never goes up, okay? Critical illness. One of the critical illness policies that I sell is guaranteed renewable for life. Let me say that again. Guaranteed renewable for life. Okay. Peter, you're still young and healthy. I don't think you've ever had a heart attack, stroke, or cancer. But what do you think are the odds that something like that is going to happen to you before you die?
Pretty darn high. I mean, I can tell
Yeah.
you that the odds of having a critical illness is 1 out of 3. So I show a dice. Actually, let me grab it real quick.
Another
I got
visual
it, right?
aid.
I got
Excellent.
it right. I got it right here. So
Excellent.
what I show my clients is would you be willing to roll a 1 or a 6? Because that's really the odds. If there's 3 people, if I'm with me and a husband and wife, the odds say one of us is going to have a heart attack, stroke, or cancer, right?
Yeah. So what that means is this policy, most insurance policies, okay, protect you against an unlikely but catastrophic event, which you still need. So you have homeowners insurance in the unlikely event that your home burns down. But if it did, it'd be catastrophic. So you want to protect yourself against the most catastrophic event first, right? But with critical illness policy, because it's guaranteed renewable for life, you're going to use it. The odds are you're going to get every dollar you put into it back and then some. But it gets even better. Not only is it guaranteed renewable for life, so you're 82 years old, you're paying the same premium you were at 30, and that policy is still in force. So it gets more valuable every year it's in force because it's cheaper relative to your age, and you're more likely to use it. Okay, and you can use it multiple times. These policies pay for what's called recurrence, meaning every time you have a critical illness event, you collect that, as an example, $500,000 lump sum benefit. Okay. But it gets even better. They come with what's called return of premium. Let's say you took out that policy when you were 30, and then you died tragically in a car accident at age 55, never having used the policy. All the premiums you paid in are now returned to your estate. So it's quite literally a no lose proposition if you can think long range enough. Okay. Good financial planning requires long range thinking. Okay. So I guarantee you, people who are in their 60s probably wish they had taken out a critical illness policy back in their 30s before they had the cancer diagnosis. Okay. All right.
And real quick, I just want to mention too, a critical illness standalone policy is an amazing option. But Logan, isn't it true that even certain term policies come with a critical, chronic, and terminal illness benefits, just in case someone is maybe younger and, maybe they should lock in a critical illness policy, but they just end up getting a term policy, but at least some term policies, they do come with it, right?
Yeah, that's correct. So there are multiple ways to get the protection that you need. I like standalone critical illness policies, but they are certainly not the only option. There are, as an example, whole life insurance policies that have critical illness riders that accomplish the same thing. Okay. And it can be a better solution, especially if you're already planning to take out a whole life policy, because now you can be more efficient with those dollars, because now the dollars you're paying into those policy are protecting you not only against critical illness, but they're also getting you the life insurance benefit that you need. They're building cash value in the policy and other things as well. So now you have $1 being paid into an insurance policy that's accomplishing multiple things for you, not just one thing. Okay. And then related to that is also a huge one that I think people are starting to become aware of, and that's long-term care, right? As Tom Hegna says, if you don't have a long-term care plan, you don't have a retirement plan. Okay. Long-term care can be a massive expense in retirement. And once again, an ounce of prevention is worth a pound of cure. Offense wins games, defense wins championships. I was talking to a guy who runs a nursing home. They require you, if you don't have long-term care insurance, you must have at least 3 million in liquid assets before they'll let you in the door. Right. They won't even talk to you if you don't have at least 3 million. Okay. These long-term care events can be obviously catastrophic. They can blow up your retirement plan. But the good news is, if you're willing to think long range, it's not hard to protect yourself against it while you're still relatively young and healthy. Okay. And there are options, even if you're not healthy, by the way, annuity-based solutions. There are other things that you can do. So if you think you're not healthy, if you think you're not insurable, please still come talk to me. There are still options. We can figure something out. Okay. Now, the best options will probably be closed to you, but something's better than nothing. Right. So when it comes to long-term care, there are pure long-term care insurance policies that you can purchase. And then me, as an infinite banking guy, one solution that I absolutely love is, if you do infinite banking, you're going to be taking out a specially designed whole life insurance policy. And the vast majority of them come with chronic illness riders, which means basically when you sign up for a whole life insurance policy, you have a death benefit in place that's probably going to be in the millions of dollars. The chronic illness rider allows you to advance yourself a portion of that death benefit while you're still alive to pay for any long-term care event. Okay. And here's the beauty of it. It's indemnity based, not reimbursement based, which means you don't have to incur any expenses to use that rider. Okay. Other long-term care policies are reimbursement based, and they're great. By the way, I sell those too. Nothing wrong with them. It's just that, let's say you have a long-term care event, but your wife takes care of you. Okay. You don't incur any expenses. Well, you couldn't collect any benefit from a reimbursement-based long-term care insurance policy because there's nothing to be reimbursed. Okay. Here, you absolutely could. All you need to do is get your doctor, keyword, your doctor, not a doctor who works for the insurance company, your doctor, to sign a one-page form signifying that you meet the requirements for long-term care need, and then you could take advantage of that benefit and spend it however you like, right? There are all kinds of non-medical related expenses that come up when you have long-term care needs, okay, that people don't think about. So this is totally flexible. It can be used for anything.
Great.
I think
And
people,
Logan, I'm gonna stop you right there because I want to actually, I'm loving this so much. I actually want to make this, we're going to do this in two parts to split it up
great,
for, so we're going to wrap this up. Thank you, Logan, so much. We're going to, at the next one, we're going to pick back up at long-term care because I think it's so important what you're saying about long-term care that I think we're going to start with a refresher on the long-term care. And then we're going to get into these other things, talking about home, auto, estate planning, umbrella liability, and all the other good stuff. So thank you, Logan, so much for doing this. I think this was amazing. If you could you just finish us up with one final sentence or two?
offense wins games, defense wins championships. Your insurability is an asset and it needs to be protected.
Did you stop the recording?